We said can't say the same when it comes to the currency, with the rupee languishing near a 7-month low against the US dollar. In fact, let's bring on board some experts to talk a little bit more about where the currency is headed. We have Ray Faris, Head of Fixed Income Research and Economics, Asia Pacific at Credit Suisse, as well as Jamal Maclay, CEO, Maclay Financial Services, who will be joining in just a bit. Ray, thank you for joining in. What's going on with the currency? And more importantly, tell us what exactly the implications are of the U.S. Treasury Department saying that now they will be adding India to the list of currencies that they consider potential currency manipulators. What exactly is the meaning?
Well, the US, let's start with the U.S. Treasury. They've got a list of indicators for currency manipulation, and countries that trip 2 of the 3 fall under their sort of watch list, if you will. And that's what's sort of happened to India. It remains unlikely that India will be actually named a currency manipulator, and if India is named a currency manipulator, as I stress, it's unlikely, it doesn't really mean anything. The sanctions, or what the U.S. Treasury is required to do under the law, that has to enter into negotiations with the country. It then is required to cut off developmental aid, and it bars the country's state-owned enterprises from bidding on U.S. government contracts. And that's about it. So for all of the sound and fury, it doesn't really matter much.
We had the trade deficit number as well that came in last week at about $13.7 billion for the month of March. Given that it's more than the deficit median estimates that most of the experts have been watching out for and has come in significantly higher, what is your outlook on how that impacted the currency? Because it's a lot of external volatility, such as that number, as well as what's going on with the U.S. bond yields. How do you see all of these factors influencing the rupee's movement?
Well, it's really the trade deficit that is the problem. The trade deficit's expanded. It's weakening the current account balance, and combined with growth being very slow to recover, those 2 factors have helped to soften the currency. There's also, for the second quarter of the year, a key seasonal that's important. The current account balance in India strengthens seasonally in the first quarter of the year, and then almost all of that reverses in the second quarter of the year. So if India had a deteriorating trade balance in the first quarter that looks like it's going to continue to weaken, in part because of rising oil prices, and seasonality was positive, sort of temporarily helping out the currency, if you will, in the first quarter, but the currency still couldn't rally. As we go into the second quarter and that seasonality turns negative, it's going to put the currency under additional downward pressure. Certainly, the central bank will try to moderate that and keep volatility under some degree of control, but we think the direction for the currency over the next couple of months is probably somewhat weaker.
Track some of the other emerging markets. What do you make of the news flow coming in from China overnight regarding the cut in their rate?
The cut on the reserve requirement is really a tweak of monetary policy aimed at maintaining stability rather than something that's really stimulus. It injected about 1.3 trillion yuan into the system, but 900 billion of that has been earmarked by the central bank for repayment of a maturing MLF facility, a form of central bank lending to the banks, leaving only 400 billion in the system. Even that has been mandated to be lent to small and medium-sized businesses, which the banking system really sort of struggles to do. I think the other thing you have to keep in mind here is that this is only a bit over 1% of monetary base in a system where foreign exchange reserves, which used to be one of the main ways that monetary base grew, are not really rising. This is an economy growing over 10% in nominal terms. This small addition to liquidity is probably just helping to try to keep up with growing money demand in that economy. So if you look at market interest rates still remain under some degree of upward pressure.
Right. Also, let's just talk about what's happening as far as, crude prices are concerned. I know you don't have a view on crude, but say if it continues to be where it is, for a country like India, it could be a big worry for the problems regarding bond rates, or rupee could come because it's a big consumption of crude.
Certainly, higher crude prices will be an increasing problem for most of Asia, more on trade accounts than inflation, largely because inflation is very low and pretty well contained in most countries. I think the main potential shock for India will really come through further deterioration in the trade balance at a time when the trade balance is already weak.
Hi Ray, this is Nayantara joining in from the New Delhi studio. Good afternoon. Always a pleasure chatting with you here on ET Now. My question to you is that we are seeing the Indian currency on a free fall. It's hit a fresh 7-month low today. And at a time when you're also seeing a recovery in the developed world, particularly in the US economy. So can you give us an idea what you guys at Credit Suisse are really making of the Indian currency at the moment, and the fact, and I know my colleague just touched upon this, but the fact that the RBI, our central governor, bank governor, may not continue to have a free hand anymore on reining in the currency?
Well, let's get this under control. Free fall is not the way to describe what's happened so far. The currency's down about 2.8% year to date. It's been pretty well controlled by the central bank. The real exchange rate is still in the upper end of its historical sort of trading range. So, this is not a currency that's collapsing. It's not a crisis by any means. It's far from the weakness that, say, the 7% fall on the Turkish lira or the 6% fall on the Russian ruble so far this year. I think also the central bank will probably look at some weakness in the currency in a controlled fashion as an adjustment mechanism to the deterioration in the trade balance. So the central bank has for quite a while, I think, been concerned that the real exchange rate is too high and that has hurt India's competitiveness. That's probably one of the reasons why they were intervening last year, resisting currency appreciation. Now that there's some degree of pressure for the currency to depreciate, it sort of makes sense to allow some of that to flow through and be an adjustment mechanism.
So we'll leave it at that, Ray. Thank you so much for joining us here. So that's a check on the rupee and how it's performing compared to all of its competitors.